Do you ever wonder why some people build real wealth through the stock market while others lose money or never even start? Here's the truth. Most people are not failing at investing because they are lazy or bad with money. They are just falling in the traps they didn't even know existed. A study by FINRA shows that 70% of millennials say that investing is too confusing. Do you think investing is difficult or confusing? I am Charity Ezengwa Onako, founder of Wealthy Gen. By the end of this video, you will understand exactly why most people struggle and, more importantly, how you can invest smarter with confidence and clarity. First of all, why do we invest? Before I started my company several years ago, I would split my paycheck into 3 different buckets. The first bucket is my bills and day-to-day spending. The second bucket is my emergency fund, the money I keep to ensure that I am secure in case of uncertainty. The third bucket is my growth fund, which is the money I put aside for my personal and financial growth. When I started creating the Wealthy Gen app, I dipped into my growth fund for that purpose. I invested some of the money I had in my growth fund to start my business and create my product. Why did I do that? I wanted to grow my money by using it to create value that other people would pay me to get. Money is just a tool. The reason you have money is to create more value. Money alone will not make you happier, but the value you create with it will. The question is, if you have a set aside money right now, why would you bother investing it instead of keeping it in your bank account and having access to it whenever you want? What's in it for you? Why do we invest? The answer is simple. We invest for higher returns and or profit, so we can grow our money and create more wealth. You might say, I can keep it in my savings account and earn some interest. That's good, but here's the thing. Inflation erodes returns on cash and savings. You invest to counteract inflation by growing your money. When you do this wisely, investing can yield returns that exceed the rate of inflation and assist you in building wealth. Remember, your money grows using the simple wealth formula, which is the money invested times the rate of return. The rate of return is the profit earned from investing your money, right? So wealth formula is the money invested times the rate of return times the time it remains in the market. Your invested money grows faster by compounding growth, which is returns earned on your returns, right? Compounding growth allows investors just like you to potentially achieve exponential growth. That is the growth that occurs at an increasingly faster rate. Investing in the stock market is a great way to grow your money exponentially. This data provided by the Schwab Center for Financial Research shows that a $100,000 invested in the year 2000 grew to $435,000 by the end of 2021. If you pay attention to this timeline, you will observe 3 major events. We've had 3 major economic downturns between 2000 and 2021. The first is the tech crash in 2000 as a result of the busting of the dot-com bubble. Then we had the Great Recession in 2008, triggered by the collapse of the US housing market. And finally, the COVID-19 crisis as a result of the pandemic. Despite all these major downturns, the stock market still returned significant growth within 21 years. So, should you save or should you invest? There are 4 things you should consider. The first is your goals. What are your plans? Do you want to use your funds for short-term goals or long-term goals? Savings can help you fund short-term goals, but investments can be used to pay for longer-term goals. Here's an example. If I wanted to purchase a car in the next 3 months or need a down payment for a house in 6 months, I will keep my money in a high-yield savings account so I can have access to it when I need it within 3 or 6 months. But if I wanted to buy an asset that generates a steady flow of income, I will invest my money rather than save it. The next consideration is whether you want income, value, or both. Investments can increase value, provide current income, or even offer you both. Savings can provide current income but cannot increase in value. So if you just want a steady flow of income through interest or dividends, then do just saving. But if you want income flow as well as the possibility of your capital to increase in value, so you can build wealth faster, then you should invest, because savings will not get you that. The next consideration is the protection of value. The value of your savings is federally insured, but the value of your investment is not. Let me explain this. If you keep $250,000 or less in your savings account and the bank faces distress, you will recover your savings up to $250,000 because the value of your savings does not decline. Your investments are also covered by SIPC up to $500,000, but this protection is limited to the current value of your investment at the time of distress. Assume that you invested $250,000 and the value of your stocks falls to $200,000. If the brokerage firm faces distress when your assets are worth only $200,000, you will only recover $200,000. SIPC does not protect against the decline in the value of your securities. The next consideration is risk of loss. There is a greater risk of loss of losing your money with investments than with savings. However, investments reward higher risk assets with higher returns and vice versa. And that's why you hear the saying that the higher the risk, the higher the return, and the lower the risk, the lower the return. So because investing has a greater risk of loss than savings, people invest to take advantage of the greater risk to make higher returns. When you do invest, keep in mind that there is a risk of loss associated with investing. Now that we know why we invest, let's look at the common problems people face when trying to invest in the stock market. The most common problem, and I consider this the biggest one, is a lack of knowledge. People are jumping into stocks because they saw it trending on TikTok or their cousin told them it's a sure thing. No research, no plan, just vibes. Would you drive a car without knowing how to use the brakes? That's what investing without knowledge is like. It's a recipe for disaster. You want to have a good understanding of how the stock market works so you can maximize your gains and minimize your losses. The next big problem is investing based on emotions. I discussed emotional spending in my previous video. You should watch it. The link will be somewhere in the description. Emotional investing occurs when you make investing decisions based on how you feel rather than on your investing profile. People invest out of fear due to news headlines and panic sell when they believe they are losing money, right? When the stock market drops, people panic. When it spikes, they get greedy. They buy high in excitement and sell low in fear. That's just completely backwards. You want to understand your investor profile and create a written investment plan so that emotions do not get in the way of your investing. The next problem is setting unrealistic expectations. Everyone wants that 10x return in 30 days story, but real investing is not flashy. It is consistent. If you're expecting to double your money in a month, you are not investing, you are gambling. Some people lose the motivation to continue if they don't meet the unrealistic expectations they've set for themselves. So you want to set realistic expectations so you keep your momentum going. Here's an example. You can say, I will invest $1,000 every month so I can increase my monthly dividends by 20%. When you do invest consistently every month, you will see your portfolio grow exponentially. Remember, real investing is consistent. The next one is having too many choices. The stock market offers different asset choices from individual stocks to ETFs to options and bonds, as well as many apps and brokerages. Many people get confused about how to even get started. With thousands of options, it's easy to feel stuck before you even start. But here's the truth. You don't need to know everything. You just need to start with what is simple. Something like an index fund, ETF, or an individual dividend stock in an industry you understand and value. The next problem is timing the market. Everyone wants to buy and sell at the perfect time. They want to buy low, sell high, but guess what? Even professional investors can't time the market right consistently. There is an adage that says, wealth comes with time in the market, not timing the market. When you invest your money, allow it some time to grow. Your investments need time in the market for them to grow. By investing now, you are giving your investments more time to grow. But if you wait to invest later, you are losing that time now that your investment could use to grow. I like how JP Morgan Asset Management put it. It says, missing just 10 best days in the market over a decade can cut your returns in half. The next problem is high fees. Hidden fees are silent killers. A 1% annual fee might not sound like too much, but over 30 years, it can cost you hundreds of thousands in lost returns. I always encourage my clients to go for brokerage accounts that charge zero fees on all transactions. And if you're investing in ETFs, mutual funds, or index funds, be sure to go for the lowest fees you can possibly get. The next one is falling for hypes or scams. From meme stocks to fake crypto coins, scams are everywhere. If someone promises guaranteed returns, run. Here's a red flag rule. If it sounds too good to be true, it is. Do not fall for it. The next problem is having no clear plan. Most people don't define their goals, their risk tolerance, or even time horizon. It's like trying to run a marathon without a route. Let's shift gears now. If you want to succeed at investing, stop thinking like a gambler and start thinking like a wealth builder. I'll give you 3 pro mindset tips. 1, think in decades, not days. 2, invest for freedom, not excitement. 3, accept that the market will go up and down and stay the course. The people who win aren't trying to be right all the time. They are staying in the game long enough to let compounding do its magic. Are you feeling ready to take action? Here is your smart investing starter pack. Step 1, define your goal. Are you investing for a steady income stream, for retirement, a house in 10 years, college fund? Whatever it is, define it. Step 2, learn the basics. Take a stock investing course. Get a one-on-one session with a coach to get your questions answered. And follow this channel so you don't miss our investing tips and gems. Step 3, start today. Start small. Even $50 a month is a powerful habit. If you're ready to start investing today, drop me a comment and let me know what questions you may have, and I'll give you my best insights. Step 4, automate your investing. Set it and forget it. Step 5, diversify your assets. Do not put all your eggs in one basket. Invest in different asset classes with different risk levels and across different industries. Here's a statistics that always blows people's minds. If you had invested just $500 a month into an S&P 500 index fund starting 10 years ago, you would have more than doubled your investments to over $134,000 today. The earlier you start, the easier it gets. You don't need to be an expert. All you need is just start, because the best investor isn't the one with the perfect strategy. It's the one who stays consistent. This is your Wealthy Gen moment. Let's make it count. Let me know in the comments what questions you may have about investing. I'll do my best to give you my insight. I hope this video helps you. Thanks for being here, and I'll see you on the next one.